Mutual funds pool money from many investors together and invest it in securities like bonds, stocks, money market, and other assets to produce capital gains or regular income for investors. In this video, I am going to discuss about types, advantages, and disadvantages of mutual funds. Before we start though, if you are new to our channel, please consider subscribing to get notified whenever we upload a new investment related video. So, let's get started. One single share of mutual fund represents investment in several stocks and other securities held by mutual fund. Price of mutual fund, which is referred to as NAV, net asset value per share, is nothing but total value of portfolio divided by total number of outstanding shares. Mutual funds NAV does not fluctuate continuously like stocks. Rather, it is settled at the end of the day. You can purchase or redeem mutual fund shares as needed at NAV. Now let us understand how mutual funds make money. There are three different ways through which investors can make money from mutual funds. Number 1. Income earned from dividend on stocks and interest on bonds. Mutual funds pays out almost all the income that it receives through dividend on stocks and interest on bonds held in its portfolio in the form of distribution. Investors have an option to either receive the distribution annually or to reinvest the income into more shares. Number 2. Capital gains. Capital gains are made when fund sells a security when its price increases. Part of these gains are also distributed. Number 3. Selling shares for profit. If mutual fund does not sell a share even when its price has increased, the NAV increases. At this point, you can sell mutual fund shares for profit. Now let's explore different types of mutual funds. There exists a mutual fund for every single type of investment approach. Classifying mutual funds is not an easy task, but I am going to attempt classifying mutual funds based on different investment approach we have already discussed on this channel. Number 1. Equity mutual funds. Equity mutual funds invest in stock market. They can be further classified depending on the market capitalization of the companies they invest in, such as small cap, mid cap, or large cap, also known as blue chip companies. They can be also classified depending on the investment approach, such as aggressive growth funds, value funds, income-oriented funds, etc. They can be also classified depending on whether they invest in domestic stock market or foreign stock market. In general, equity mutual funds are moderate risk and moderate return investments. Number 2. Fixed income funds or bond funds. These mutual fund focuses on investments that pays out set rate of return, such as corporate bonds, government bonds, or other debt related instruments. These funds are often actively managed to take advantage of fluctuations in NAV. Number 3. Index funds. It is a well-known fact that it is hard to beat market performance consistently over the long run. This is the reason why index funds buy stocks that correspond to major stock market indices such as S&P 500, Nasdaq, Sensex, etc. These mutual funds are passively managed as they require less oversight. Number 4. Balance funds or asset allocation funds. These funds invest across different asset classes such as stocks, bonds, money market, and alternative assets. These mutual funds reduce the risk of exposure to a single asset class. Allocation across asset classes can be fixed or dynamic. Dynamic asset allocation allows fund manager to take advantage of market conditions and business cycles. Number 5. Money market funds or liquid funds. These funds invest in short-term, low-risk or risk-free short-term debt instruments such as government treasury bills. These mutual funds are considered to be safe to park the investment. The returns are usually low, but still they are slightly higher than fixed deposit. Number 6. International and global mutual funds. International mutual funds invest only in assets located outside the home country, whereas global mutual funds can invest anywhere in the world, including the home country. It can be a good idea to include these in your portfolio for diversification. Number 7. Specialty funds. These funds are usually focused on investing in certain sectors of economy or targeted sectors such as regional mutual funds, which invest in a particular region or country, or socially responsible funds such as green funds that do not invest in companies that deal with fossil fuels. Number 8. Tax-saving mutual funds. Tax-saving mutual funds such as Equity-Linked Savings Scheme, that is ELSS in India, provides tax benefits along with returns. Now let us discuss various fees and charges associated with mutual fund investment. Number 1. Expense ratio. Mutual funds usually charge an annual fee in the form of a fixed percentage of investment to cover the administrative charges as well as advisory and management fees. Number 2. Shareholder fees. These fees cover for sales charges, commission, redemption fees, etc. These fees are paid directly by investor at the time of buying or selling the shares. These fees are also called load, and depending on whether they are paid at the time of buying the shares or selling the shares, they are called front-end load or back-end load. Some mutual funds are no load, that is, don't have to pay any commission or sales charges. There can be other charges associated with mutual funds, such as penalty for early withdrawal before specified time. Now let us discuss some advantages and limitations of investing in mutual funds. Now let us discuss some advantages of mutual funds. Mutual funds provides an inexperienced investor an opportunity to invest in a professionally managed and well-diversified portfolio at a reasonable fee. There are a variety of mutual funds options available to choose from depending upon your investment strategy and preferences. Another advantage of mutual funds is economy of scale. For a small investor, purchasing small number of different stocks is expensive considering the commission and other charges. The mutual fund fees are comparatively lower. Now let's talk about some of the limitations of mutual funds. Mutual funds fees are comparatively higher as compared to exchange traded funds or ETF. Also, to cover up for buying and selling of mutual fund shares, some portion of the portfolio is always kept in cash, which does not yield any returns. If you like this video, please smash that like button and share the video with your friends and family. Thank you.